Business owners, your tax write off could be writing you right out of your mortgage approval. And nobody warns you of that until you are already sitting in front of the lender being told that your income does not qualify. You may have a profitable business, money may be flowing through your bank account every month, but when you apply for a mortgage, the lender cannot simply qualify you based on what you say you make or everything that is being deposited into your account. For self-employed borrowers, they are going to review documented income, your tax return, your business cash flow, and whether the income appears to be stable enough to continue. And this is where the problem starts. Every year, business owners sit down with their tax preparer, focused on one goal: how can I pay the least amount possible? So they write off everything that they legally can. And listen, I completely understand wanting a lower tax bill, but if you are buying a home or if that is part of your plan, you also have to understand what those deductions may do to the income a mortgage lender can use. Because the IRS may see a business that is reduced in taxable profit, but the lender may see someone who does not show enough stable qualifying income to support the mortgage that you are asking for. I had a business owner who did not understand why the deposit in his bank account looked healthy, but the mortgage approval kept falling apart. His bank statements told one story and his taxes told a different story. By the time he discovered that disconnect, his taxes had already been filed. So this is why I say your tax strategy does not just begin in April, okay? If you want to purchase a home in the next 1, 2, or 3 years, your tax professional needs to know that and understand that when you guys are preparing your taxes, not after your lender has already denied you. Now, that does not mean that you stop taking legitimate deductions and intentionally start overpaying taxes. It means that you stop making decisions that without thinking about your future or what you're trying to accomplish. You need a plan, okay? What you owe the IRS, what income you need to be documented, what your business can support. All of that should fit into your financial goal and your way of thinking, so you make sure that you qualify. Your tax return is not just your record of last year. For someone who is self-employed, it can become evidence of whether your income that you are claiming is stable, documented, and usable. So before you celebrate getting your tax income as low as possible, ask yourself, what will this help me qualify for? Because you cannot plan only on your tax bill and then be shocked when that same decision does not support you getting a mortgage. And if you are self-employed or you are trying to be a homeowner, that should be part of your plan, your tax strategy, your approval strategy. All of that fits in the same conversation. Start with the approval ready review so we can review your financial documents and actually communicate your goals and see where we need to be, okay? On the next episode, I'm going to share the write-off mistake that costs business owners more than it saves them. Stay lifted, stay covered, stay aligned.